What exactly is the outlook, and do you think it's going to be something where the markets react negatively to this particular round of shutdown talks?
So on the market reaction, it's interesting because it's a little different this time than September. In September, I think a lot of people were expecting a shutdown. Investors have been talking about it for weeks. It feels like the chatter this time around is muted. I don't think it's getting as much attention. So I don't believe that markets normally react to government shutdowns, but because I think there's also less of an expectation of a shutdown, there could be a very short-term negative reaction if there is a shutdown. But when you look back over history, even for long, protracted shutdowns, markets don't react negatively. In fact, the last two shutdowns we've had, the market has rallied during those shutdowns. So, the market and the politics are disconnected here, Dom.
So Brian, speaking of the rally that we've seen, it hasn't just been the stock market that's been rallying, but arguably the part of the market that should be rallying or selling off even more because of these types of talks is the bond market. And there's still a bid for government bonds here in the U.S., despite a perhaps more questionable auction for the 30-year long bond this past week. But interest rates are still generally lower than they were at the cycle highs. How much of the deficit talk, the shutdown talk, and everything else is really going to have an effect on that U.S. sovereign bond market?
I think limited, because I think the talk that's going on right now is limited to a very small portion of the budget. When you look at the overall budget, what drives long-term debt, and I think, and thus issuance and what's impacting the fixed income markets, that's entitlements and interest paid on the debt. And lawmakers are not talking about that. They're really talking about 30% of the budget, which is currently discretionary funding. And if you look at that and that portion and just slice it down, it's half of that, 15% is defense. And in this era, we're not talking about lower defense budgets. We're talking about more defense spending. So we're now into that 15% of non-defense discretionary. And there are programs in there that Congress is not going to cut. Really, the cuts that are being floated out there are unacceptable to the majority of lawmakers. So the current debate really isn't a particularly serious debate on long-term debt. And I think that's what investors really are looking at in terms of fixed income.
Brian, just in the last few days, credit ratings agency Moodys has been out with commentary downgrading the outlook for U.S. sovereign debt. They call some of the brinksmanship, perhaps, some of the machinations in Washington, D.C. with regard to shutdowns and deficit negotiations as the reasons for why. Do we feel as though this kind of brinksmanship, so to speak, is playing right into Moody's narrative about a possible downgrade for the U.S. market and its debt?
Yeah, I mean, I think Moody's has set up a construct in which it's almost impossible for the government to meet its Moody's expectations. I mean, we live in an era of brinksmanship. This brinksmanship is not new. It's been going on for several years now. So I was a little bemused, for lack of a better word, by the downgrade, because they're talking about a political reality that has existed for quite some time. We're not going to get out of it anytime soon. We're just in a very chaotic and divisive era. The country is fractured. So getting to some kind of consensus on the future of policy is very difficult, and that leads itself to brinksmanship. So, that's the political reality that Moody's and others are going to see for the foreseeable future.